The Operator Log, Episode 18. What we observe. The human to logic ratio, the one metric that identifies breakable markets. How ARCO measures structural vulnerability before committing to a market. Last week, we covered what not to build, the three structural conditions that disqualify a market regardless of its apparent attractiveness. The preview named this week's subject precisely: the human to logic ratio in full, how to calculate it, and what it reveals about an incumbent's structural vulnerability. The human to logic ratio has appeared throughout this arc. In episode 5 as the primary market selection filter, in episode 13 as the inbound measurement for agent-facing commerce, in episode 17 as the test for systemic resistance. Each appearance used it as a threshold. This episode is the full treatment: what the ratio actually measures, how it is calculated at the operational level, what three structural conditions confirm it, and what the target outcome looks like when an autonomous competitor enters a market where the ratio is high. Most markets look competitive from the outside. Few are structurally efficient. The difference between a market that is merely crowded and one that is structurally vulnerable can be measured with precision. In the traditional economy, a high human to logic ratio is read as a sign of service quality. At ARCO, we read it as a sign of structural weakness. This is the operator log. The human to logic ratio measures how much of a business's operational output depends on human intervention and coordination versus deterministic systems and autonomous logic. A high ratio means the system relies heavily on people to bridge the gaps between tasks, to move information from one state to the next, to resolve the ambiguities the workflow was never designed to resolve automatically, to make decisions that follow a fixed sequence but have never been encoded as such. A low ratio means the work is executed through rules, systems, and computation. The gaps have been engineered out. The ambiguities have been anticipated and handled. The decisions are code. The ratio is not always visible at the surface of a market. Many industries present themselves as a complex, bespoke, and relationship-driven. In practice, large portions of their operations are predictable and deterministic. Customer support workflows, document classification and routing, scheduling and capacity matching, multi-party status coordination, invoice preparation and reconciliation. These functions are often embedded within higher-level services in a way that creates the appearance of complexity because the humans performing them are experienced and the context surrounding them is genuinely complex. Strip away the context and examine what the humans are actually doing at each step. A client intake coordinator receives a request, classifies it against a set of known categories, routes it to the appropriate team, confirms the routing with both parties, and updates the record. The surrounding context, the client relationship, the account history, the business terminology is complex. The tasks the coordinator is performing are not. They follow a fixed, repeatable sequence. Every step is deterministic given the right inputs. The work is a state machine wearing the clothes of a professional service. The same pattern appears in document processing at law firms, in trade confirmation workflows at brokerages, in property management at real estate operations, in back office compliance at financial institutions. The firm charges a premium because the surrounding context requires expertise and the client relationship requires trust. The underlying operational workflow requires neither. It requires a rule engine, a schema, and an exception protocol. A firm operating this way has a structurally high operational drag. It is paying the coordination tax, the overhead of a human-to-human alignment across every step of the workflow, to manage a process that should be autonomous. The operational drag is not a temporary inefficiency that will be resolved by the next hire or the next process improvement. It is compounding. Every time the firm grows, it adds headcount to manage the additional coordination surface that the growth creates. The coordination tax scales with the business because the workflow was designed around it, not against it. The firm charging a premium for coordination is not delivering a sophisticated service. It is charging for the inefficiency of its own architecture. That premium is the operational arbitrage, the gap between what the market charges for the service and what an autonomous competitor needs to charge to deliver the same output. The gap exists because the incumbent is pricing in a cost structure that the autonomous competitor does not have. The human-to-logic ratio becomes precisely measurable when applied to the revenue loop, the repeatable sequence of steps that generates a transaction in the target market. The calculation begins there. For each step in the loop, the question is binary. Does this step require an active human decision, or does it execute deterministically given the right inputs? The ratio is the proportion of loop steps that require human coordination versus those that can run on logic alone. A market where 80% of loop steps require human intervention scores a high ratio. A market where 80% run deterministically scores a low one. The 60% gross margin threshold that ARCO uses as its primary selection filter is the practical proxy for the ratio at market level. When human labor accounts for more than 60% of gross margin across the incumbent's cost structure, it signals that the human-to-logic ratio is structurally high across the revenue-generating workflow, not just in supporting functions, but in the steps that produce the product the customer pays for. That is the signal. The labor cost is the evidence of the ratio's magnitude before the revenue loop has been fully mapped. 3 observable structural conditions confirm that a market's ratio is high for structural rather than incidental reasons. That the incumbents are not just poorly managed, but that the market's delivery model has never been designed for autonomous operation. The first condition is administrative density. A high percentage of the workforce is dedicated to operations or coordination rather than direct value creation. In a breakable market, the majority of staff time is consumed by activities that intermediate between the work rather than by the work itself. Briefing, aligning, reviewing, approving, updating, escalating. These are not value creation steps. They are the overhead generated by a workflow that requires humans to bridge its own gaps. When administrative density is high, the ratio is high. When the ratio is high, the coordination tax is compounding. The second condition is deterministic loops. The core revenue-generating tasks follow a repeatable, predictable path that can be mapped as a decision tree and encoded as logic. Not every step, but the majority of steps. The exceptions are real and the edge cases matter, but they are exceptions, not the rule. In a market with deterministic loops, the T-tier classification established in episode 1 applies cleanly. Most of the revenue loop is Tier 1 or Tier 2 work, scripted and conditional, with a minority of genuinely novel decisions that belong in Tier 3. When this is the structure, the human-to-logic ratio can approach zero as the architecture matures. The logic can own the process because the process is, at its core, logic waiting to be encoded. The third condition is a fragmented competition. The market is filled with small to medium players who all share the same high-cost, human-heavy delivery model. No single incumbent has built a structural advantage. Each player manages human variance rather than eliminating it. They compete on reputation, relationship management, and the ability to handle the coordination overhead more smoothly than the player next to them. When these 3 conditions converge, high administrative density, deterministic revenue loops, and fragmented competition, the market is not competitive. It is stagnant. The fragmentation is not evidence of a contested market. It is evidence of a market where no one has found a way to scale without proportionally scaling headcount. The operational drag is distributed equally across all incumbents. The coordination tax runs at the same rate for all of them. The human-to-logic ratio is structurally high for every player in the market. That is the opportunity. The named target outcome of entering a market that satisfies all three conditions is the revenue-to-head count advantage, the point at which an autonomous business generates 10 times more revenue per employee than the incumbent it displaces. Revenue-to-head count advantage is the measure of whether the architecture has successfully decoupled output from head count, whether the business is generating value through logic rather than through labor. When it reaches 10 to 1, the operational arbitrage has been captured. The margin the incumbent was charging for its coordination overhead is now structural margin for the autonomous competitor. The conventional reading of fragmented competition in an active market is saturation. Too many players chasing the same customers, margins under pressure, and little room for a new entrant. The autonomous business model inverts this reading entirely. In a labor-intensive service market, fragmentation signals something specific. No incumbent has been able to build a structural advantage through architecture. If operational efficiency were achievable through the existing delivery model, consolidation would already have occurred. A player with superior processes would have outcompeted the others, grown to dominate, and the market would reflect that concentration. The persistence of fragmentation after a decade of stable demand means no one has found a way to scale without proportionally scaling headcount. Everyone is hiring to grow. Everyone is managing human variance. Operational drag is distributed equally across the entire market. That is not saturation. It is a market waiting for a competitor who does not share the same cost structure. An autonomous architecture does not need to outfeature the incumbent. It does not need superior relationships or longer track records. It needs to deliver the same output at a structurally lower cost. In a fragmented market where every player's cost structure is human-centric, that bar has never been cleared, because the existing delivery model cannot clear it. The fragmentation is the evidence. The decoupling that the human-to-logic ratio is designed to measure is not the elimination of human effort from the business. It is the isolation of human effort to the work where it creates irreplaceable value. Every business has two layers. The judgment layer is where humans make decisions that require context, discretion, and accountability, the decisions that belong in Tier 3 of the T-tier framework. The execution layer is where the work is performed according to rules that have been established by the judgment layer, Tier 1 and most of Tier 2. In legacy firms, these two layers are fused. A human must execute the task because the system was never designed to understand the judgment that governs it. The consequence is that human time is consumed performing deterministic work that logic could own, while the genuine judgment that requires human input is buried in a workflow that makes it structurally difficult to find and isolate. The firm cannot separate the execution from the judgment because the system was not designed to do so. It was designed around human execution, which means the judgment and the execution are structurally entangled. The architectural work of reducing the human-to-logic ratio is the work of disentangling them. The execution layer is redesigned for autonomous operation. Agents execute the deterministic steps, machine-readable interfaces prevent handoff, friction at integration points, and execution divergence protocols surface the exceptions that genuinely require human assessment. The judgment layer is isolated to the steward role, managing the architecture, resolving the exceptions the system surfaces, and expanding agent authority as the design proves stable. When this separation is complete, the human-to-logic ratio approaches zero in the execution layer. The judgment layer remains human, but it is a fraction of the total, not the majority. A final distinction that completes the picture established in episode 17. The human-to-logic ratio and systemic resistance are not synonymous conditions. A market can have a high ratio without having systemic resistance. That is the breakable market. high coordination overhead that exists because of a legacy design, not because of structural requirement. A market can also have a high ratio with systemic resistance, the false positive, where the coordination is legally or structurally mandated and cannot be replaced by logic, regardless of architectural capability. The ratio identifies the size of the opportunity in both cases. Systemic resistance determines whether that opportunity is accessible. Both tests are required before committing to a market. The ratio comes first because it identifies where the work is and where it is not. What is the human to logic ratio and how does ARCO use it to identify breakable markets? The human to logic ratio measures how much of a business's operational output depends on human intervention and coordination versus deterministic systems and autonomous logic. ARCO calculates it by mapping the revenue loop, the repeatable sequence of steps that generates a transaction, and classifying each step as requiring human decision or executing deterministically. A market where human labor accounts for more than 60% of gross margin passes ARCO's primary selection filter. Three structural conditions confirm a breakable market: administrative density, high percentage of workforce in coordination rather than value creation, deterministic loops, core revenue tasks map as decision trees encodable in logic, and fragmented competition. No player has built a structural advantage, meaning no one has scaled without proportionally scaling headcount. The target outcome, a 10-to-1 revenue to headcount advantage. 10 times more revenue per employee than the incumbent displaced. Here is the verdict on the human to logic ratio. Most markets look competitive from the outside. A market with thousands of active players, billions in revenue, and incumbents who have been operating for decades presents as saturated. The human to logic ratio reveals what the surface does not. When the revenue loop is primarily human intermediated, when the majority of steps require a person to bridge the gaps between tasks, the market is not competitive. It is structurally expensive. The incumbents are not competing on operational superiority. They are competing on their ability to manage the same inefficiency more smoothly than each other. That is not a moat. That is a market waiting to be rebuilt. The three structural conditions that confirm it, administrative density, deterministic loops, and fragmented competition, are observable before any engineering capital is committed. The calculation method is straightforward. Map the revenue loop, classify each step, measure the proportion. When the ratio is high and systemic resistance is absent, the operational arbitrage is available. The autonomous competitor does not need to outperform the incumbent on the dimensions the incumbent values. It needs to eliminate the cost structure the incumbent cannot remove. While others are hiring to grow, we are designing to scale. The full written version of this argument is memo number 18, the human to logic ratio, on the blog at arcoventure.studio. The precise definition of every term introduced across this arc, including human to logic ratio, revenue to headcount advantage, and operational arbitrage, is in the ARCO lexicon at arcoventure.studio/lexicon. While others are hiring to grow, we are designing to scale. Next week, how to choose a market that actually works, the complete selection framework, the order in which the filters are applied, and what the process looks like from the first observation to the commit decision. Technology changes what is possible. Ratio determines what is profitable. This has been episode 18 of the Operator Log.